Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this interview preview with Ian Bezek. So how are you positioning yourself for the start of 2017? Anything particularly you're excited about or maybe concerned about?
Yeah, in the U.S., I like consumer staples this year. That's the products that we buy day after day, food, beverages, paper products, and things like that you just can't live without. The sector as a whole fell 5% over the last 6 months of the year, which is a sharp divergence from the rest of the market. And I was looking at Wall Street, various analysts, and 8 out of the 10 analysts that were polled were negative on consumer staples for this year, despite them already falling at the end of last year, diverging from the market. So I think people are throwing out a lot of decent companies there. They're not especially cheap, but you can buy some that are under 20 times forward earnings, that pay reliable dividends. And it feels like people are kind of overlooking this heading into this year.
Because companies, consumer staples are typically pretty stable companies that have a long track record and stuff. And so for them to fall 5% in 6 months, that's a pretty significant drop for companies though of that size. And then correct? Mm-hmm. Yeah. And so for analysts to continue to be bearish, then that's expecting a really a pretty major drop in those prices, which would really be uncharacteristic apart from maybe a major market-wide event. Is that accurate?
Yeah, and a lot of the ones that I like specifically are down 15-20% off their 52-week highs. And you have to be selective. A lot of the consumer staples aren't showing any revenue growth, and in that case, yeah, it makes sense why their stocks are declining. But you look at like a Hormel, for example, that reliably grows earnings 8-10% a year. It's down 20% off its 52-week high. It's trading under 20 times forward earnings. It's not going to be a home run performer, but the odds are very good of generating 8-10% returns over the next couple of years, which is, I think, better than you'll get from the market as a whole.
Yeah, especially on a fairly stable company. So Hormel obviously would be one of the ones that you are optimistic about. Any others that you mind sharing?
Sure, I like Brown-Forman in the liquor space. It sold off pretty sharply over the past 6 months. And I like McCormick as well, another packaged foods player. Awesome.
So you like U.S. consumer staples. What else do you like?
Overseas, I think Britain is probably still the most compelling opportunity for people that want developed markets, something they feel secure with. There's a lot of yield opportunities there as well for people that want higher yields. The telecom stocks over there yielding 5% or more, and I think they offer a lot more value than the U.S. alternatives. And in emerging markets, Mexico is a good opportunity. Chile should also have a good year. Copper prices have soared, and that's the economy there. And I don't think investors have caught on to that yet.
Excellent. Anything you're concerned about specifically? You mentioned high valuations overall in the markets, and we're closer to the end, the beginning of the bull market. Any other specific things that you're kind of have a caution flag out about?
Yeah, I'd be nervous if I owned a lot of energy stocks. They're trading back. A lot of them are trading back to prices that they were at before oil started to decline. I don't see how a company that was worth one price when oil was at $90 a barrel is worth the same price today when it's at $55. But people seem very optimistic that OPEC will fix the oversupply and that the U.S. producers are going to go broke, and so there will be less supply. But I don't think that's going to work out. If you look at Exxon or Chevron and forecast oil stays at $50 or $60 a barrel for the next 5 years, their valuations don't make any sense.
Do you, and this probably may be outside of your focus, like for some, like a solar company like First Solar, for example, that's usually pointed out as being one of the more, strong balance sheets, one of the more solid solar based companies. And, but I guess, and so, but with the drop in oil prices, obviously solar's been hit hard as well. And I've wondered, well, maybe that could be a good opportunity for a company like First Solar. But I guess as long as oil prices stay relatively low, there shouldn't be really any big expectation that a company like that should see notable gains in the near future. Correct?
I'm not sure if there will be notable gains in the near future, but they have a strong balance sheet, and they're the best, in my view, they're the best player in that industry. And so with the stock down this far, I think a patient investor could start establishing a position slowly, knowing they may have to sit on it for 3 or 4 years, but the stock will probably double or triple coming out of this downturn for alternative energy.
Right. That's good to hear, because it's one that I've been watching. So
it looks very cheap unless you think that fossil fuels are going to totally stamp out the alternative movement, which I doubt.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.